Thank you all for joining today. We'll just wait 1 or 2 more minutes perhaps for the latecomers to join, but I'll perhaps just begin by just saying hi to everyone, and I'll quickly introduce Yen for today, who's going to be speaking to us about both the sort of general experiences in investing, and especially in investing in public markets, but also speaking much more in depth on the sort of topics which hopefully all of you are interested in, and could get sharing a lot of his wisdom and insight, which I know a lot of you watched his videos before through his YouTube channel. But yeah, we're going to be sort of diving deeper on some of the topics he previously talked about and exploring a few others. So yeah, perhaps maybe we'll begin with the first question of just sort of Yen describing his background a bit more, but just at a high level, Yen is the managing partner and founder of Aravat Global, a fundamental long-short and a long-only equity hedge fund. He began his career as a consultant, working at Bain & Company in San Francisco, Sydney, Singapore, and Beijing, before beginning his MBA at Harvard. After graduating there as a Baker Scholar, he moved to a family office, Ziff Brothers Investments, before then founding Aravat in 2014. With that, Yen, I'll pass over to you. And but perhaps if you want to maybe just share a bit more about yourself, about your background, how you first got into investing, just for the audience to better grasp that.
Fantastic. Well, thank you, Johnny, and thank you all. First of all, I'm dialing into you guys from Sarasota in Florida. It's absolutely stunning out there. It's nice to actually see people physically again and their smiles out in warmer weather. I hope you guys are all safe and well. I can't wait to come and hopefully visit in the next cycle. Please keep this as interactive as we possibly can in the next hour. Good luck in your finals that are coming up in a couple of weeks. Thank you for sharing this time with us. First of all, before we dive into the details of this, I want to make this a really interactive conversation. I want to make it a very pragmatic conversation. I'm going to take this out of academia. We're going to make this very raw. We're going to make this very human and hopefully make it very fun. I want to make sure it's practical. And so a couple of quick introductory points. First of all, you're hearing Aussie. I grew up in Melbourne, Australia, but I'm actually Malaysian Chinese. I was born in Kuala Lumpur, Malaysia. I call this talking series, you guys most included, into the universities around the world that I couldn't get into as a child. So it's a thrill and an honor to be able to speak to all of you. I have tremendous goodwill for you in the careers that you choose. Thank you also for turning on these cameras. I know these conversations, this is not going to be a monologue for an hour. This will be a conversation, and we'll keep it very raw and very human. So my background quickly Johnny touched on. So I grew up in Melbourne, Australia. I studied law and economics at the University of Melbourne, also actuarial sciences for 2 years, and decided that triple degree was probably not the smartest thing I ever did in undergrad. Tried to major in partying for that third degree. Joined Bain & Company for 5 years, which was an incredible transformative experience for me in learning businesses, lots of them. Started in San Francisco, then moved to Sydney, Singapore, and Beijing. That was pre-HBS. HBS was both the .com ascent and descent while I was there. So I came in 99 and graduated 01, started my job actually in public markets the day after 9/11. So when markets reopened, was the first day the markets reopened after 9/11. So quite a tumultuous set of couple of years in there. My public market experience actually started when I was 14. I invested in stocks when I was in Australia. Didn't know what I was doing for the first 16 years of my investing life, and then joined a private family office that ended up being a deca-billion-dollar equity market strategy called Ziff Brothers Investments, where I ran 3 groups for the next 13 years. I ran TMT, Energy and Agriculture, and then started Aravat Global in 2014, and we've been running that for the last 7 years. So my passion in investing, just as a quick aside, I fell into hedge fund investing by accident. I actually had a startup with Barry Diller, one of his divisions, in the summer of 2000, and that blew up very quickly. And one of my close friends from Bain & Company, Ian McKinnon, who was the portfolio manager at Ziff Brothers Investments, had been asking me to come to New York for many, many years. We'd known each other since San Francisco days. And I had no idea what a hedge fund was. I thought I'd go to work in private equity. Bain & Company has a division called Bain Capital. That's where I thought I would go after business school. But private equity had absolutely no needs for anybody. Baker Scholar or not, it didn't matter. I couldn't even get interviews in private equity. And frankly, the serendipity of having this opportunity at Ziff changed everything in my life. And we can talk a lot more about what hedge funds are and public market investing, but it's been, if you are intellectually curious and competitive in nature and like to be accountable for decisions of consequence, it's an extraordinary industry. If you're academically inclined and can't handle the truth of feedback loops that are not always fair, please don't come. If you have to be a reformed perfectionist in order to handle the pressures of public market investing, and all of you are more than academically capable, we'll get into the emotions and the damage of very public mistakes. You need to be grilled in order to prepare for that, because you won't survive here if you don't. With that optimistic end to the soliloquy, back to you, Johnny.
Yeah, thanks, Ian. Perhaps just, you said that you were drawn into public markets itself, but obviously it's like a very wide and diverse sort of field. Just perhaps at a high level, do you mind sort of telling us about Aravat and like what exactly you do, how you compare to long only firms and then other hedge funds, both your multi-managers, your sort of Citadels, 0.72s, and also from other sort of single managers? Like, yeah, I guess what is Aravat's strategy? How do you apply it? Do you have any sort of examples perhaps which illustrate it, just so people can get a grasp perhaps of, yeah, absolutely, I guess what it is you do?
So public market investing is incredibly wide gamut. And let me define a few things for you. First of all, there are lots of ways to make money. There is no single way, and we do not claim to ever have the right way. There are different ways that have a higher probability outcomes than others. There are definitively ways to do it wrong, but there are literally dozens, if not hundreds of ways to do it right. And there are a lot more in the short end of the spectrum than there are in the long end. The long end, there's very few. And what I mean by that in terms of duration. So short-term trading versus long-term investing, the two camps are very, very different. The short-term trading camp, there's tons and tons of strategies. We don't do that. We do the long-term investing methodology. Now, with that, let me frame one thing for you all, which is you're at the start of your careers. Here's what the Hall of Fame looks like so that you should know where you want to land. The Hall of Fame is 15%, 15 years net returns to your client. That will get you broadly in the room. What will put you on the front page of the Hall of Fame is 20 for 20. 20% net returns for 20 years is a 40x, 38 to be exact. So that's the zip code of what you're trying to compete against in order to get into the elite right tail of the investment world. So what do you do in order to navigate that? And what did we do specifically? So there are two primary drivers when you're, and this is just a single security and then separate our portfolio management separately. You have to decide, are you a trader in adding value, or are you a fundamental analyst in earnings accretion and value creation, and then allow price arbitrage to merge with price creation? We are in the latter camp. So our portfolio, how we're different from the Citadels, et cetera. So first of all, from public market investing, we've got the first vector, which is very short-term trading or long-term investing. We're in the private equity version of public market investing. That's vector one. Vector two is, are you now based upon trading to create value, so arbitraging multiple, or are you on the earnings power of free cash flow accretion end of the spectrum? Everybody wants a little bit of both, but you kind of need to know which one you are. We're much more heavily on the second than the first. We're much more business analysts than we are stock pickers or traders. The vast majority of our portfolio, excuse me, creates most of its value from free cash flow accretion over long periods of time. Next part of this, which makes us really unique, is we are truly long-term investors. So our fund is 7 years old. Almost 40% of the fund is 5 to 7 years in length. Our preferred holding time period is forever. We churn the bottom half of our portfolio. The top end of our portfolio, which finds the right tail, doesn't need to be trimmed. If it continues to compound at 25 to 30%, or 20 to 30 is our range, we leave them to do their thing. So two examples for you that gives you some illustrations of what we do. And I'm sorry, one more part of my strategy, or the most important part of it, is it's based on deeply studying the history of the right tail. And what I mean by that, for those of you who have history majors, by the way, it's an extraordinary discipline in order to be applied. It's a wonderful discipline that can be applied to public markets if, again, you can handle the emotions of it. We study the deep patterns of the right tail. So 3% of securities over the last 26 years have compounded at over 20% for 10-year rolling cohorts that are liquid. So that's defined as above $1.5 billion in market cap. We've studied these, hundreds of these, over the past 15 years, literally hundreds and hundreds of them through a case study methodology. We've decoded the strategies and we've decoded what works for us. So the strategy for Aravart Global is we hunt oligopolies and monopoly growth stocks. They effectively compound earnings at 2 to 3 times what market averages, closer to 20 to 30%. They trade at reasonable prices. It's a form of GARP, and we like to do it for as long as we possibly can. So we call them horses. On average, these oligopoly and monopolies compound at 20 to 30. Our realized trailing 4 years is 20. Our prospective 3 is 30. And we try to get them at very reasonable prices. So our GARP is, our pegs are usually close to 1 to 1.5. And that combination lets us be deeply invested through cycle and take advantage of volatility. But let me give you quick examples of what some of those companies may look like, and then back over to you, Johnny. So 2 positions that we've held for almost 7 years now is TransDigm and Constellation Software. TransDigm is an aerospace company. Over 90% of what TransDigm produces, it's an aftermarket aerospace company. So it controls the vast majority of the smaller pieces that have to go into your planes. These planes are controlled by an FAA, the Federal Aviation Association, that actually looks after, from a regulatory perspective, all flying safety. After a certain number of flying miles or takeoff and landings, you are forced to replace the parts. Well, these guys have 90% of their revenues literally have no second source. It's an exclusive monopoly of a large number of tiny niches. This has been a business that's been compounding at almost 30% for 13 plus years, and it's not slowing down. And so it's a wonderful capital allocator. It's done through a private equity type model in public markets. That's one example. The second example is Constellation Software, which has been one of the highest performing stocks in Canada. This is over 600 vertical market software businesses that have been rolled up into it. Every one of those 600 are mini, either monopolies or heavily oligopolistic. And they have been incredible in acquiring them, upgrading them, and compounding them. And without a levered balance sheet, they've compounded at the high 20s for almost 15 years. And so one of the central premises of our business model, we don't like competition. And competition is great for the consumer. It's terrible for capitalists. And so we try to find niches, and it depends on the size of the niche. So Google is another position we have. The niche is enormous, but it's extremely hard to compete against Google. We don't like fair fights. So if there's one tagline you want to take away from our investment style, we only fight unfair fights. Like, our teams win constantly, and it's not even close. We don't like mano a mano situations of battles. That is a hellish place to try to compound capital over multiple decades. You want your teams turning up every day and the whites of the eyes and their competitors, because we decide who we crush that day. Those are the teams I look to back, but I look to find them and then wait for price in order to engage with them. Anyway, back to you, Johnny.
I mean, I guess there are many, many follow-ups to this, but just as a first one, maybe this idea of, business has historically been a really good allocator of capital. They take the cash they generate, they give some back to shareholders, maybe, that they buy some shares back, or they give dividends, and they take the rest and they invest it, and they, continue to have like a high return on that invested capital. How do you look and actually tell, business has done this well for the last 10 years, maybe 15 years, maybe even 20. How do you sort of know if it's going to continue to do so? How do you sort of try and assess the durability of a moat going forwards? Again, like perhaps in the context of Constellation or any other companies, like how does this work in practice, trying to see how durable is the moat going to be going forwards? Can this business remain a horse? Can it continue to compound capital in this way?
Phenomenal question. So we have one fundamental true north, which is we believe over time, and it only matters after year 3, that earnings power and price appreciation converge. So in the short term, multiple dictates a lot of total return. Like, in less than 1 year, it's the vast majority of it, both directions. But by year 3 through 5, or at least 5 through 10, it's almost irrelevant. So that's one true north that's really essential in our business model. If you give it time and we're right about earnings power, that is the expected return profile of our stocks. That's our true north, actually. So you touched on a couple of things in here, and it's durability, not just of the moat, but the growth algorithm. Why the growth algorithm is the rate at which earnings power or free cash flow per share plus dividends can keep going on for as long as we possibly can, because that dictates our total return. And the moat is the precursor to it, but the growth algorithm is what drives it. So let's start with the moat. And the other thing that we could probably say is, here is the variant perception of what we do. We are anti-faders. So it's persistency that we actually are exploiting, right? 97% or 95 to 97% of markets will revert back to the cost of capital over time. That is one of the fundamental laws of business, of markets, right? You have to erode profit pools because it attracts competition. Well, we explicitly hunt the ones that don't. And so your question, Johnny, on like, how do we assess that the past is the future? You've also touched on another elemental part of our business model, which is we try to underwrite that straight lines, very attractive straight lines, stay straight. We like all of our charts look the same. Over time, there's this nice up in 45, right? There's lots of these, but it's that. And it's almost monotonous how they all look alike with volatility characteristics, but you pan out and it's got this nice line, you pan in and it's like, whoa, right? But they all look like that. And so our stocks, in order to generate these types of total returns, are hitting 52-week highs all the time. And so the question for you that you asked again here is durability and persistency of the growth algorithm and the moat. So the moat number one, and by the way, this is the reason why we're unlikely to get disintermediated by AI, because this is where the liberal art of the sport comes in. It would be super easy just doing quant analysis going back and forward, that it's like anything like this henceforth is that, then that's probably another lesson for you all. There are no distinct formulas in investing. It's not that easy. This is a multi-trillion-dollar industry. If it was that easy, it would be competed away. That's the whole nature of it. But there are heuristics or tendencies that are enabling conditions for certain other elements to hold true. So let me start with the moat. The reason why the moat is the first of all elements for compounding is, in the absence of a competitive moat, your unit economics degrade. And anything multiplied by a less than 1 degrades the ability to compound at a fast rate. So that's why it's so important. Everybody keeps talking about moats, my God, but do you actually know what creates them? And then what evidence do you have that they still exist? That is something we spend an enormous amount of time on, and it can be distilled. So it's distilled into 3 core elements for you guys. I'll save you literally 15 years and 10,000 hours. Here are the 3. The first and most important one is competitive win rate, right? If you have an advantaged business model, you just win a lot more than you lose. So customer retention and competitive win rate is the dictator of, are you an advantage or not? If you're an advantaged business, you literally just win more, right? The second one is it must be demonstrated in pricing power. If it doesn't manifest in pricing power, what is the point? And if you don't have pricing power, it tells me you don't have a really good business. And so that is reflected in gross margin stability, mix adjusted for the business units. It's not EBIT, it's gross margin. The third one is high returns on incremental capital. Because if you're going to the last elemental component of compounding is you must put the capital back into the business. And henceforth, you want high returns on every incremental dollar, and you need to know how to allocate it. That's the evidence that I look for in that does a moat exist. I may not even know why it exists. If these things hold, I know it exists, right? So that's where the art meets a little bit of science. Now, the growth algorithm actually is the bigger one. The vast majority of our businesses that end up being kicked out is rarely because the moat gets cracked. We have made that error before, and I'll happily talk about that mistake in a second. I've only made that error once since we started Aravat, where we got the moat wrong, and that was Pandora Media. Actually, let's just hit the mistake. Why not? Let's set the trend, right? The dirty laundry first. So Pandora Media, in the first year of our business, this was you guys all know what Spotify is, because you probably all use it, and Pandora was effectively a push version only of Spotify, and was the largest radio station equivalent in the digital realm in North America 7 years ago. And then Spotify came out with, there's lean back and lean in. So lean in is you curate your music. Lean back is someone else curates it for me. And what we started seeing in this one was the competitive win rate really went down. They couldn't retain their customers. And as soon as it ends up being more difficult to retain and attract customers, what ends up happening is instead of scaling your business, you get decrementals. It becomes incredibly difficult to hold on to your business, yet alone grow it. And the math explodes. Like what should have been your elegant model goes in exactly the opposite realm, right? And so fortunately for us, we know what to look for when we see moat cracks. And frankly, we sold it at a loss, but if we didn't move on, we would have sold it at a 50% even further loss. But that's that one. Last thing I'll say back to you, Johnny, is the growth algorithm is the vast majority of the reasons we sell our horses, or they price themselves out. We got reasons for selling, but the growth algorithm, if we can't see a significantly long runway of 20+% earnings power without too much difficulty, I want gravity to pull us up above 20, not to struggle to hit the 20 line, we sell it. Why? Because it has no chance over the next 5 to 10 year period returning north of 20% compounded returns. Our mission is 20 for 20. If we can deliver 20% net returns, unlevered gross to our clients, 20 net is our goal, just to be fully clear, because we have a levered balance sheet. But if they can't individually return north of 20% for long periods of time without that much difficulty, we just go to the next thing. We run a concentrated portfolio. We don't need that many. Anyway, lots of things in there, but back to you, Johnny.
Yeah, lots of things and lots of follow-ups. And thank you, Gautam, for your question. We'll definitely come on to that in a second. And just some general questions about target prices and entry levels and things. But perhaps it's just a sort of a slightly different follow-up. You talk about how you need to have this long runway for growth and earnings power. You want the continuous reinvestments on capital to keep yielding more and more earnings. Do you think that, I'm sure there is a point, but how do you sort of know when the time comes that a business should stop reinvesting and instead begin to just start passing cash back to investors? And if a business does reach that stage, would you then necessarily exit from it? Or do you think there could ever still be a compelling case to stay in as it continues to grow less, but give you back more cash?
Yeah, so the growth algorithm is total return driven. So you've got organic, inorganic, you've got and then cash return components of this. So you want to know what the earnings algorithm is and then how the cash flow comes back to you, because all I care about is total return. So it's a fairly nuanced question you're asking. I can give you some live examples of this. So the first one, we've had a position in Charter Communications for 7 years. It's a cable company in the United States. And it's one of the John Malone entities. And Buffett's talked about the fast-running elephants. Fast-running elephants are those that can deploy enormous amounts of capital into the ground at very high rates of return. So we own Five Below. It's a discount retailer in the United States that has 150% return on the four-wall box. So for every box they put into the ground, they get 150% cash-on-cash return on that box. Unbelievable. Like, you guys can run the math. It's like 7-month payback on, like, they put the money into the box, bam, 1 year, the money's already back out, okay? Now, there's a physical limit to how many boxes they can open in a year, but you want them to open as many as they possibly can on a sustainable fashion for as long as they possibly can. We owned another company called Dollarama, does the same thing in Canada. They hit a stage where they could no longer continue to reinvest that capital and started spinning off a lot of cash. It's effectively what happened to Walmart in 1980. So what happens now in your growth algorithm is like, okay, the original organic growth algorithm was reinvesting capital into the ground, or in in Charter's situation was acquiring cable companies. Now, when that stage ends, you have a choice of what do you do with the excess capital. You either dividend it, buy back stock, or you do M&A. Right? The internal uses of capital are now gone. Well, that's all part of, now in your calculus of the growth algorithm. So Charter Communications stays levered around 3.5, just shy of 4 times net debt to EBITDA. It's part of their growth algorithm where they're buying back somewhere between 5 and 7% of the company every single year. So even though organic growth on its top line is reasonable, it's not super high growing, you get a little bit of operating leverage, you have a levered balance sheet, and you use it to buy back stock, you start stacking them all together, you get way north of 20% returns on earnings power accretion. So the simple answer again is, and I think what you're also hitting on is a much bigger question. The role of management has, there's no point, if you own a stock for less than a couple of years, don't even bother looking at management, because there's nothing they can do in that short term that's going to influence your outcome. It's irrelevant. If you're holding periods 3, 5, 10 years, now you're talking. Why? Because the management team is the allocator of the key resources of your company. It's time and resources in managing the physical assets and the people, but then they're also allocators of the physical capital. And that last one, over a 10-year period, that's a lot of capital to redeploy. And I'm not just talking about dividends and buybacks, it's R&D, it's investments in sales and marketing. They're allocating all of the money. So that's a really critical question, and you have to think about how to analyze it. But in a compounding formula, how they redeploy capital is quite an important factor in total return.
Thanks. And I suppose just another follow-up question to your previous, also slightly to do with management, but you talked about the importance of sort of pricing power and the possibility of exercising it. I was wondering how you like to think about both perhaps at a theoretical but also at a practical level of pricing power versus volumes growth. Is pricing power perhaps sometimes overrated? Is it better to push forwards volume growth for now and then leave pricing power until the end? Or do you think that good businesses are able to do both at the same time? I mean, perhaps as a practical example, I noticed one company in Aravat's portfolio, which I looked at myself, was Vail Resorts, the ski company. And recently, for instance, they cut the prices of their ski passes quite substantially. At first, the market reacted. They were like, we don't like this. Our thesis has gone on pricing power. The stock fell. But I think it's just since appreciated back to its previous levels. I think people are starting to realize that the volumes growth could justify the cut in prices. Yeah, would you mind perhaps just sort of talking about the relationship between the two and how you like to think about them a bit more?
Wow, such an analog question, Johnny. So in the digital realm, there is no difference between price and volume, to be fully clear. So if you run a software business, what's the difference? Your COGS are virtually nothing. So it depends on your gross margin structure. So for the digital world that has literally 90% gross margins, there is no difference between pricing power and volume. Right, so that's probably point one. Point two is, let's just take it back into the analog world, and Vail Resorts is just a great example of this. And separately, there's a meta question in here. I don't think in ors, I think in ands. I think or questions are frankly novice questions. I think and questions are master questions. And the best teachers and frankly the smartest people in the world don't make those compromises. So here's how I think about it. And the first form is, it matters tremendously what type of business model you're in. So Vail, despite being an analog business model, volume and price are interchangeable, because they run a asset which has to be utilized. It's like a hotel, right? Every day that someone is not skiing on their mountain, they're not getting it back. It's not as if that's inventory waiting to be sold. It's gone, right? Henceforth, price and volume are actually fungible. You need to know how to manage elasticity of demand. So one of the reasons why we love Vail and have been investors in them for over 3 years now is their team came from Caesars, the gambling company, 300 data scientists. And these guys play chess while everyone else plays checkers in their industry. And they have all the data in understanding usage patterns and how to influence utilization of their core asset. So what they have, by the way, they profoundly have pricing power. They did not choose to do this in reaction to what their competitors were doing. They did it preemptively with the ability, with quite high conviction. By the way, I don't know of any management team that has taken a voluntary price, 20% price discount with no competitive pressure. I mean, this is, in my view, Rob Katz and his team, like, I take my hat off that they're courageous, but they do it with data. And so I have absolute conviction they know what they're doing. And to make also the generalizable trend on this, price alone is not a sustainable strategy. I think that's also where you were going. If you're just gouging your clients, at some point they'll get pissed off. And great businesses for sustainability is win-win. pricing power means you can cover your input cost variability and then a little. Doesn't mean you have to go there and just gouge your client. That's not a great outcome. But also price has some trade-off for elasticity of volume growth. So a healthy revenue growth algorithm has, like I also say pricing power, I don't want decrementals. I don't need necessarily incrementals. I don't want any decrementals. So especially this is really important in an inflationary world. You don't want a business, a high quality compounder or a high quality horse. We have pricing power in every asset we own, pretty much every asset we own. And so irrespective of what the volatility of input costs, when you are a monopoly or an oligopoly, it means your clients can't go get what you want, what you give somewhere else. Hence what you have pricing power. The question is just how do you exploit it? And I think the most sustainable strategies are ones that are fair, not ones that are gouging. You want your clients to win. The best businesses in the world make their clients better. They're not there to hurt their clients.
Yeah, definitely in agreement. And no, I'm a big fan of Robert Katz, and I feel confident leaving money in Vail that he'll do his magic and try and compound it. And yeah, I mean, I think that Vail still does have this pricing power, and you know, they cut the prices of these ski passes, and they make everyone come to the resorts more, where they then charge everyone, you know, inflated prices for ski rental and food and all of this other stuff. So I think, yeah, it's a sort of genius business model at heart. But yeah, but perhaps sort of moving on to something slightly different. So this is a question which Gotham sent into the chat box before. So he was talking about how do you figure out when to exit your position in one of these sort of horse businesses, and with a compounder play, do you have a target price or do you wait for something in your thesis to change? I guess this probably falls into just the broader theme or question of how do you generally think about both entering and exiting your investments? Do you look for a fair price at a given point to enter at, or if it's a sort of long-term play, are you happy just to stay in it? If the stock sort of shoots upwards at one point in time, then do you sort of sell or size it down? Or again, if it's a long-term play, are you happy to hold on? And even if you get drawn down a few more times, you know, given the long run potential, is it fine just to hold on to it?
Okay, lots of different stuff in there in execution, and Gautam, let me know if I'm hitting your questions. Otherwise, just keep peeling it back until we do. So here's a couple of paradoxes. When you're talking about really, really high quality businesses, so Visa's been a position we've owned for many, many years. When was the right time to buy Visa in the last 10 years? Every single day, right? You would have made money if you bought it every single day. If you can hold on to it, TransDigm, if you were the worst investor in history and you picked the highest point in every single day this past decade, you probably returned 16 to 17% on TransDigm. If you were that good to be able to top tick every little top tick, you still made high teens. So if you choose a really good game, one of the paradoxes is you got to choose a really good game, but the paradox is we're very disciplined on price entry, but we have to own it at prices we wouldn't buy it at. This is a profound paradox. And by the way, the paradoxes is where all the real money's at. Why? Because if we could teach our formulas to Oxford, well, you guys would generate, you know, hundreds, if not thousands of new versions of us every single day. It's not that easy. It's the paradoxes that's where the real money's made. So paradox one is valuation discipline is an art. So entry point is looking for great attractive entry skew. Why? Because it's psychologically more satisfying. Having said that, that will optimize total return, but you still would have made a pretty damn good return if you just bought it anyway, right? So our discipline is we have a whole stable of current ones and ones waiting to get in, and we're very patient on when we load new ones. But paradox one is you can pretty much buy them anytime, and then paradox two is you have to hold them even when you wouldn't be buying them, or you can't capture 5 to 10 times your money. And there's a whole art form in how you do that ride phase. Let me flip it on a second on the exits, and then come back to ride phase and thinking through how do you actually execute this. There are 4 reasons we sell. One is we're just wrong. Easiest one in the world. By the way, actually not that easy. Sometimes you don't even know you're wrong, or you can over sweat it. And that is something that younger analysts will sweat like crazy. Why? Because you can't, it's hard for you to see how wrong you are or the opportunity cost of your time. unless you've got lots of different ideas and you've experienced a few of these and it's just got awful when you've been hit, you just don't want to really admit it. So there's a lot of biases you have to overcome. That's point one. Point two is you're already paid for your thesis. This is a tricky one. When are you paid for your thesis? So we buy stocks that can compound at 20 to 30%. Some of these can go up, like we've got one, Evolution Gaming, it's up 140% since August last year when we bought it. We haven't sold a single share, right? We think this company, we can make a lot of money on it. Evolution Gaming, it's based out of Sweden. It's the largest provider of live casino gambling in the world. It's our largest position, but it's up 140%. We haven't sold a single share, right? So, and by the way, that's happened to us many, many times, because over a 5-year view, we believe we're still playing for a lot, and it's very difficult to sell, buy, sell really high quality businesses. There's too many decisions you've got to get right. That's really, really hard. Third one here is you just have better uses for the money. So it's related to the first one's just an absolute. I'm paid for my thesis. The risk skew is terrible on a multi-year look. Just sell it. I don't even need the capital, just sell it. The third one is I've got things that are fighting in the portfolio that can use the capital better. There's I call it the Thunderdome. Thunderdome is two positions go in, only one comes out, and you're fighting for capital. And then the fourth one is they hit risk limits. We have certain risk limits, risk protocols, but by factor, by sector within our portfolio. That's portfolio management skill and how much risk exposure you want, and that will force us to trim positions. We don't tweak. We generally either cut or add in fairly substantial chunks. I don't believe in tweaks. We run a concentrated portfolio where our top 10, it's usually 20 positions. Our top 10 is usually around 90% of equity in our long short portfolio and about 70 in our long only portfolio. So we run pretty chunky. But let me pause there, and then Sonny, tease out what I didn't cover in the original question, because there was probably about 4 questions in there.
I mean, does this like perhaps related to the original question, but just like on exiting,
Yep.
I guess when you invest in these sort of compounded businesses, you feel a sense of attachment almost to businesses, like you really love the business, and you believe in the management team, you believe in the long-term earnings potential of it. And in terms of exiting, like as you say, sometimes it can be quite hard to say, like, has your thesis been fully exercised? Has it sort of fully played out? Do you think that there's a bias perhaps to sticking with the companies which you know and trust, which have given you good returns in the past, as opposed to reinvesting that money away into something new, which offers perhaps better and more compelling risk reward skew? This is perhaps like sort of orthogonally related to the original question, but I think it sort of hits it. Something just, on the very art of like exiting, and how do you do it emotionally? Like, it's a great company, you love the management team, it's brought you all these great returns in the past. How do you sort of detach away from that and then reinvest the money into something with a better risk reward profile?
Okay, there's a lot to unpack in there. So one of those is just biases in general. And, there's tons of cognitive biases in this business. And I actually think the emotional element of this business is the element that I would strongly advise all of you to invest really hard, really early. And I studied Buddhism for this reason, because I believe there's a bunch of things that are delusions of the mind that stop you from seeing reality. I actually think there is a profound philosophical and religious or spiritual side to investing. I firmly believe that half of there's so many inefficiencies that stop people from actually seeing the facts. This is a business of dealing with the future, and henceforth it's fairly unknowable, but there are things which you make it even harder if you can't see the facts for themselves. And so one of the cognitive biases that you've talked about, it's called the endowment effect, is you fall in love with what you already own. It's been successful. There's nothing more dangerous than a successful stock, right? You get blinded by performance. By the way, downside volatility is called volatility, upside volatility is called skill. And it's just like, you fall in love with your own skill, and you have to have ways that keep you in check. And we have systems that try to put numbers around this that avoid it. And that's a team approach. It's a systems built approach that try to manage, those biases. And one of those tricks I'll share with you is like, and I firmly believe this is a life lesson. If you only have one, you'll never, ever see anything. You can't see the nuance of anything. I'll just give you a small live example of this recently. I had to have my son's bedroom repainted, and like they put up 5 different shades of white. I couldn't, honestly, I looked at each one, I was like, I can't, this is all white to me. You put them 5 right next to each other, oh my God, that one's got a green in it, that one's got blue in it, that one's got a gray in it. It's like, you just literally can't see. So for those of you who think you've seen the Mona Lisa, do a puzzle of the Mona Lisa. You've never seen her. None of you have never actually seen her. Cognitively, that's not how your brain works. It interpolates, right? So you think you've seen her, but you've never actually seen her. So do a puzzle, whether it's 30 or 600 pieces or whatever, now you'll really see her, right? And so that's part of the game in developing your eye and being able to tune. The bias is you need to have many. So we own 20 of the best businesses in the world. We have another 30 waiting to get in. And when you have 30 waiting to get in, it's like, you know what, at this point, like, you know, it's not quite as good as it used to be. Well, it's like, well, this one's battling to get in, that one's battling to get in. Now that's a separate bias too, the next shiny thing. So you guys all have, you know, a half-life that's fairly limited at this point. I'm an old dog. I've seen many more of these and I like them to run for as long as I possibly can. The next shiny thing, if you've spent multiple thousands of hours, like for TransDiamond Constellation Software, we literally have spent, gosh, thousands and thousands and thousands of hours on these positions, and we're still learning from them, which is staggering. Either that says something that we're slow learners, or these are just extraordinary businesses that we keep on peeling back. But the next shiny thing always looks better than the existing thing when you're younger. And you have to be really careful with this because there's also an information asymmetry. So the information asymmetry is like, if you spent thousands of hours on understanding something, we are probably more volatility resistant than we would be when we're brand new to something, because the knowledge base is not anywhere nearly as established. We understand how the businesses react, we understand how the peoples react, we understand how the competitors react, we understand the industries work. And that has to be offset against, no matter how much work we do, if our experience base is 1,000 hours and we haven't been invested in that stock for anywhere near as long as the others, under extreme stress, one is going to be superior than the other in the way that we handle it. And so there's a few layers on top of that, Johnny, that I hope helps answer that question. But we use a couple of things to stop the bias. One is we use disconfirming information first. We highlight everything we possibly can find. Every quarterly call, every call we ever do on our existing positions are highlighted in a different color, anything that disconfirms our thesis. We don't need affirmation. Our stocks work. When they're left alone, they just work. They don't work every day, they just work over time. Henceforth, our job is to always look for the cracks, because otherwise the straight line stays straight. And then the other part of that helps us is the more you have to compare, the more you see. And the most dangerous investors, in my view, don't have a lot of ideas because they can't see it.
Well, thank you for that. And maybe I'm sort of picking up on something which you mentioned in the middle. You said, you know, you own 20 businesses, there are 30 waiting to come in. How do you think about sort of weighting your portfolio between the businesses which you do have? Like, you know, let's say you love Constellation, you love Vail Resorts. How much do you put into each position? You know, did you just allocate roughly equally from the start? Or is there some component of, you know, how expensive is the stock right now? Do you have a sort of system of, you know, a target price with certain upside you expect in a year, a sort of 5-year IRR, and then, you know, you size up and down accordingly? Or how do you actually go about building this portfolio? So you have all these great companies, you have the great companies who are waiting to come into the portfolio. How do you actually go about building it? Yeah, and then we have a question in the chat from Sai about risks and things. We'll come on to that perhaps next. But yeah, just on a high level, how do you build it?
So first couple of things is there are certain decisions which you just do a lot of them. And so you need to form basic rules or heuristics that just take away the energy from those types of decisions so that you can spend that resource when you really need them. And I would say like north of 90% of decisions are actually fairly generic, right? And so once those are thought through and they're clear, it's just much faster. So first and foremost for us, we've chosen a game of very high quality growth businesses at reasonable prices. So we've already curated a game, a very target rich environment, and then you just have to wait for price. So that's a separation, risk decisions from research decisions. How do we actually enter them? So here is the actual, literally the rules that we use. Our sizing parameters are 3, 5, 7, 10, and 12. Why there's that many steps here? All right. And by the way, why those numbers? We generally enter between 3 and 5%. First, press the button, and we do it all in one hit. And that's usually for the first 6 months, maybe even up to 12, if it's a new industry and company we're unfamiliar with. Why? Because it's just an admission that we don't know yet. And so we have very low turnover in the top part of our book. We have more turnover in the lower part of our book, because no portfolio day one is a perfect portfolio of all winners, right? Portfolio management skill actually is dealing with realities. We're dealing with a world that is vastly imperfect, and henceforth, what's the future? It's unknowable. You need to have a strategy that evolves as new information is discovered. So we have an extremely tax efficient portfolio because our winners run, but we churn until we find our winners. And even with all of our effort, we cannot, and no one can, who will present to you unless they're dishonest, will know what a portfolio of total winners looks like, right? So here's where we go on the sizing parameters. So 3 to 5 is where we start. And there's clusters also. This is just a single position version. We love to be somewhere around 7 last dollar in. And we can let 7 last dollar in run for ages. Why? Because we can kind of just leave them alone, right? We'll go to 10 or 12 when provoked. There has to be very attractive risk reward skew. We have to know the industries and the companies really, really well. Those are the sizing broad parameters that we go into. There's no absolute religion on every one of those. By the way, just one thing I will also say to you guys is, like, as 4Os, you can white knuckle the hell out of a system. There's a lot of art that goes with this science, and don't knuckle an art into a science. It doesn't work, right? So there's so much, pardon my French, shit in, shit out in models. It's false precision. And so there's so much false precision in this industry. Loosen it up a little bit, right? You have to allow it a little bit. You have to let your theses breathe. You'll strangle your best ideas if you don't. And so part of this is we have to allow variance. So I'll give you one other paradox. In order to have a 20% returning portfolio, does every position need to have a 20% return? And if every position needs to have an immediate 20% return at all times, it means you'll never be able to capture a 5 or 10x your money, ever. Why? Because if a stock goes up 20% or 40% and started at 20, it's going to dip significantly lower on a 2, 3, 4, 5 year basis forward projected IRR. You have to let it run even when its return profile looks a little lower. And ironically, that's just on your best view, right? But the world changes. And this is the ride stage is incredibly complicated in this genre. This is pure art. And there's lots of subparts into this. But what we actually do is we have 3 portfolios each side on a long and a short book. Live portfolio is 20 positions, backup portfolio. So book 1 is live, book 2 is a curated, fully researched inventory. That's about 20 to 30 more longs. We have 40 plus shorts on that. And then the book 3 is a curated universe of targets around the world that when we have time, we go hunt them down. The second book is the secret sauce of our portfolio. If we have rock star positions that can't get in, oh my God, I know I'm sitting on gold, right? And what the whole point of that is book 2 is you're just waiting for an attractive risk reward skew to put capital to work and knock out something from book 1. And that's the real key for us. So we can come in hot and heavy. If we've been invested in a stock that we've known for ages, an industry we're super comfortable in, there's nothing stopping us coming in day 1 at 7 to 10%. That's generally not what we do, but there's nothing stopping it. We generally start between 3 to 5, and then we'll build it up to 7, and we'll build it up to 10. The difference is our style of investing is we can be in these for 5 to 10 years. If your style of investing is event, short-term variant perception, you better come heavy fast, because your thesis is going to evaporate fairly quickly. Henceforth, you have to size quickly. And that's a very different approach. Our batting and slugging averages are miles higher than professional averages. For this reason, time is our friend. The average batting average for institutional investors is around that 50%. They're wrong literally half the time. Ours is a lot higher than that. Slugging ratio is $1 to dollars lost. That's the key number that matters on compounding capital. We have our style of investing. Time just cures a lot of ills. Anyway, yeah, please, if I didn't touch on any aspect of that you'd like deep, and just guide me down the trail, Johnny.
No, you absolutely touched on it and done a lot more. I definitely want to follow up on the stuff on precision and the art of putting numbers in models and things. And Jack, I've seen your question. I think this is really connected. We'll come back to that in a second, but perhaps it's just a more direct follow-up. Sai here is asking, just to do with portfolio management. In running a concentrated portfolio of compounders, how do you think about managing exposure to factors, sectors, and geographies? And could you just share a bit more about your sort of risk protocol?
There's lots of risk protocols, but factor exposure. So when you manage all risk, and this is the way you have to construct a portfolio, is you have to think downside first. And so the level of concentration for any factor or single position is, it's effectively exposing you to different types of risks. The first is you're just wrong. Okay, if you're wrong, how much damage can you take from being wrong? And it's all drawdown risks that you're managing in constructing a portfolio. The second then comes into rotational factors or fundamental macro factors. And all again is how much damage can you take and not get knocked out by yourself, your partners. And so it's factor and it's mistakes times gross exposure that determines your risk budgets. We have one factor that's overarching, and we have to fully embrace it because it's tautological to our strategy, which is growth. We're growth investors, right? Now, growth is a very wide paradigm. You can have hyper growth companies that are trading at 50 to 100 times revenues. We're GARP, right? So we're 20 to 30% that trade at 20 to 30 times forward cash flows. The beauty of what we do, market draws down 20 or 30%. Our businesses go from attractively priced to stupidly cheap very quickly. They either recover themselves or we can redeploy capital within our portfolio, but it allows us to stay very, very deeply invested. Gosh, where else was I touching on that? So risk factors, you were saying. So this is highly dependent upon your own risk tolerance and your understanding of the volatility tolerance of your partners if you're investing professionally. We make it very clear to people that we are quite risk tolerant. So what we say is single industry, we'll go up to 25% exposure on it if the industry shock factor is idiosyncratic. So for example, we have more than that in various parts of technology. We just don't believe anything coordinates them. Our single position risk is 20% at market on a single position. We'll let it run to 20. And that sector I mentioned was at 25. And then growth takes all of it. Now, a couple of other very important risk protocols is you need to decide what you do into a drawdown. And this was a fundamental shift for us. And it's energetically really important to get it right. We, after 300 basis points, have lost alpha and a long from its peak. We don't add any more incremental risk. Doesn't mean we stop loss it. We just don't add more risk. We hold through. Why? Because I worked at Bain & Company. They have a thing called the 1% possibility. The 1% possibility is no matter how hard we try, there's at least a 1% chance you're wrong. And in investing, it's closer to 50, but for us, it's closer to 20. And it's just like, you have to always admit that we could always be wrong. And you have to have a limit where you just stop adding risk. So if a drawdown, let's just say it was a 10% position, for us to lose 3% alpha, so against, irrespective of the index, we would have had to lose 3% on a 30% drawdown in a market that was flat. We can add risk until it hits that loss 3. But once we hit that loss 3, it's a cardinal rule. We don't add any more risk. Why? Because we could be absolutely wrong. Now, when a position's that big, the only most important thing is you just have to be right. You don't need to add any more risk. But there are other places that will pound the table and say, you got to keep adding, you got to keep adding. Well, you know what? It only takes, in a concentrated portfolio, your highest conviction idea that is wrong is what will kill you. Your highest conviction idea that you don't know is wrong is the one that will kill you. And henceforth, you have to design risk into your system to do that. And on the short side, we have a slightly different variant because you have to avoid the right tail It's a very different design. It's a diversified portfolio because the error rate is that much higher on the short side. You have to manage away the right tail. So if we lose 100 basis points of alpha in a single short, it's a clean knockout immediately in quarantine for 12 months. Can't come back into the portfolio. You have to have these risk protocols built into your system.
Well, thank you for that. Really, really in depth. I guess just maybe for the last 15 minutes, I wanted to move away to this last topic of the art of modeling, of using numbers in actually sort of trying to understand how you generate returns for clients numerically. So you spoke about how you can't be perfect when you input assumptions into a model, and if you try overly so to just try and get every number exactly right, you're wasting your time when you could be understanding the industry, understanding the business, understanding the durability of the moat, the growth algorithm and things. That said, would you mind sharing with us, I'm sure that you use some form of modeling. Do you mind just sort of sharing at a high level how you like to think about translating a thesis on a company? For instance, if you think Constellation or Vail or something has a really strong moat, how would you go about trying to put that through in the numbers? Would you focus on just high level average selling price and volumes and try just look at these things? Would it be something to do with TAM math? Would it be something to do with trying to really disaggregate the revenue into 500 different line items and having the Vail epic one day pass, the retention rate, the conversion rate of that into a different pass? Like, yeah, on a sort of practical level, how do you actually think about building a model for a company? And yeah, it's how do you build a model, and then how do you translate that into potential returns which you might generate investing in it?
So the model is purely the quantitative expression of your insights. And the first thing I'll tell you is the bigger the model, the worse the investment. I call it crayon math. The best ideas, you don't even need a sharp pencil. You need a blunt crayon, right? I mean, the really big ideas are simple and you can explain it with clarity. And now it may take a lot to get to that clarity, to be fully clear. The next part of this is you need to understand directional excellence in a model, because you're not out modeling a market. Don't kid yourself. No one will out model a market. And variant view is also only valuable when you understand when it's variant and at what price. Those 2 points are grossly missed. It's just like, first of all, I don't even believe that you know something the market doesn't know. There's probably other people that do. But markets are sufficiently inefficient that even if you know what the market knows, at a different price, it's valuable. That's another paradox, right? And actually, that's a more important and valuable and repeatable paradox, actually. But how we do it in modeling is you want to keep it as simple as possible, but not too simple. And then all those inputs. So let's walk through the different parts of this. So where is the moat in the model? The moat in the model is we have sensibility and predictability of what the growth algorithm would look like and what gross margins would look like and what returns on capital would look like. By the way, those are the biggest drivers of an entire model, right? So if a moat if you don't have a highly protected moat, and that's the whole reason why we invest in monopolies and oligopolies, you can't predict. So this is actually probably the most important thing we ever did. You could spend 10,000 hours on an industry that's highly competitive and highly cyclical. You have no predictive ability because the competitor tomorrow could wake up and go, price war, right? You have no ability. COVID, like something, right? It's like everything, all your assumptions went to crap because of one thing. It's a competitive industry. There's no link. There's no R squared between the past and the future. Henceforth, all that effort doesn't change the fundamental mismatch. That one decision of no competition allows the link between the past and the future. It's the one most important link. There's no by the way, your conviction in a low quality industry tells me everything about you, tells me nothing about the position. You're an idiot, right? It's like you're convincing yourself that hard work, you know something that is impossible to know. Right? You're lacking self-awareness and you are dangerous, actually. So that strategic choice of no competition creates forecast ability. Like we're in the business of predicting the future and arbitraging price between price and intrinsic value. You have no basis to predict the future when you have competition in it, right? Now, the future is a set of variables, to be fully clear. The future is a band, it's not a single point. So there are ways to do it that way. It's just so much harder. Coming back again to the model, the growth algorithm is the next part of this. So fade rate in earnings power is based upon the premise again of monopoly versus oligopoly versus other. And then the next one is the size of the TAM, total addressable market. If the business is still world conquering, if the TAM is still enormous relative to the size of the business, it should not fade. And if the revenue growth algorithm doesn't fade, then your unit economics won't and your cash flow generation won't. Those are the really important parts of this. So there's a lot of qualitative work that feeds into a quantitative model. Now, there's also other parts of seeing reality. We have a forensic accountant on our team. Why do we have a forensic accountant on our team? Well, I'm an accountant by training. It is incredibly difficult digesting all the financial analytics that come into even modeling something with perfect information. So having a forensic accountant helps us see reality through the numbers. But we also have investigative journalists who work with us who are trying to piece together a mosaic of what the real world looks like so that they can be inputs into the model. So in summary, the couple of things I would share with you is our model just gives us a sense of what's important. How does the business model really work? What are the key variables that flex it the most? And then it also allows us to invert the world. What is the market kind of thinking is happening with this company? If you believe this is what's the value of it is 1, 2, 3, 4 years out, we generally value things 3 to 5 years out. Looking backwards, market's fading one of these variables, I'm not sure which, and I don't know why. And we have a view against it. So I'll give you another example of this. We bought Microsoft a year and a half, actually in Q4 of 2018. China scare, tech was selling off hard. My software analyst comes in and goes, we got to buy Microsoft. We've been working on it for a while, we got to buy Microsoft. I said, okay, what do you know the market doesn't know? He goes, nothing. I said, what do you mean? He goes, they're going to hit consensus. I was like, all right, explain. And it was like, walk through it. It's like, they will absolutely hit what is forecast for the next couple of years. They should beat, I don't know, but we don't need to because it's really cheap right now. And this thing will compound at a very nice clip. And you're literally getting multiple monopolies inside this thing for a song because the market's selling everything right now, right? We made a fortune on owning a gigantic market cap that hit consensus numbers. Why? Because we could tell that the market either didn't believe it or frankly, they weren't even looking at numbers at that point. And so you can make a lot of money on businesses that are in plain sight, hitting consensus numbers if you invert the price at very attractive entry points. And so you don't need to over model it. You just need it to be directionally accurate. Now our team, again, because of the game selection, we actually do analyze our team's forecasts in every stock that we have on a forward 3-year basis. We have a history of it looking back and we do this on a regular basis to find out where their biases are or their accuracy is. And the game selection of monopolies and oligopolies dramatically shifts that. We shifted only to exclusively monopolies and oligopolies in 2016. We used to run more energy and variant perception ideas as well. This changed everything in our ability to forecast. Hopefully that answers your question, Johnny.
Yeah, definitely. I hope this also touched on a lot of what, Jack, you were asking before on basically looking, what Jack was asking was, correct me if I'm wrong, just this idea of, what is the market missing? Is it always just that they misappreciate the magnitude? Also, sorry, that they're overestimating the fade rate and thus sort of underestimating the growth in earnings potential. But perhaps on a sort of related note, so you talked about, you can just hit consensus numbers and still deliver really good returns if, the market might just not be thinking about what the consensus numbers are. But would you say that's universally true, or do you ever sort of look at, this is what sell side consensus is, this is what the median sell side target price is, I'm coming in 30% above on sales 5 years forward. That's where my upside's coming from. Do you think there's any sort of benefit in general to looking at where the consensus is on the sell side? And I guess it's a related question, but does the sell side consensus accurately reflect what's being priced into the stock at a given point in time?
No. Sell side and buy side are very different. Look, sell side does extraordinarily good work and is very, very helpful. But sell side expectations and buy side expectations, I mean, it's constantly fluxing because, you know, that's the whole nature of markets is expectation driven, it's flow driven. And this is probably another very important thing for you guys to anchor is in the short term, it's purely flow driven, supply and demand meeting for a single security. Over the long term, earnings power and price will match. But in the short term, it's completely flow driven. And so there are going to be long periods of time and often, you know, sometimes violently actually, where what are people thinking? They're just selling. They're not thinking. They're just doing what they have to do. And there's a whole bunch of reasons that you'll never understand. And I wouldn't waste any time even thinking about it. And this is where it comes back to inversion. The game of expectation investing, that's short-term trading, is a game. I'm the last person to qualify to advise any of you about it. That's not my skill. I don't even know how to refine that skill, but there are other people who are gifted at it. I'm not one of them. So, you know, short-term expectations, quarterly catalyst-driven stuff, not our game. Batting average for that, I just don't think is great. We play games that are highly advantaged, and time arbitrage is the biggest advantage. So there's another question within your question, Johnny, which is where is the variant perception, or when is the variant perception? And for us, it's never in year one. It usually lies in year 2, 3, 4, or 5. And that's called the anti-fade, where markets will fade our growth rates, our margins, our returns on capital, our valuations. And when they realize that our businesses don't fade, they re-rate them. It's a persistent inefficiency. So the number one thing that is highly in shortage in capital markets is patience, right? They just don't have the staying power to invest in long-term periods. So the average holding period for the S&P 500 is well under a year at this point, right? We literally have 50% of 130-something% of our long growth that's over 5, almost 7 years old. And if it persists, don't touch it. Like, let it do its thing unless you're being forced, you've been paid for your thesis.
Yeah, Jack, I definitely hope that answered the question, covered it in depth. But if not, like, do feel free to send something else in the chat or jump on. But yeah, I guess on this note of, like, you know, the market is sort of overly fading your variables. Do you like to look at this empirically? Do you like to do a sort of Mabusin style reverse DCF and say, you know, the market is implying that it's going to grow at this and this rate, that the margins are going to be roughly at these levels. My variant view is that, you know, 5 years down the line, this is actually going to be the case. Revenue will have been higher than what's being implied by the reverse DCF. Margins will be better. Free cash conversion will be better. Did you like to do it empirically, or? Yeah,
no, I mean, you know, the inversion method, Michael Moses is a friend of mine. I think he's one of the best thinkers in the space. And, you know, that's for always invert. But the simplest way to describe what we do is it's straight lines anti-fading. Our straight lines stay straight, and it's endemic on us to prove why, not to prove why the market's wrong. It's to prove why we're right. And then it's what do we know versus what's being priced. And so all we're doing is inverting based upon price. We don't ever know what the market's thinking. No one does. It's an unanswerable question. But I can tell you what you are kind of assuming when you give us a price. So I have no idea who's transacting, but you give me a price, I can kind of tell you what will happen over the next 5 or 10 years, sort of. I can't tell you what's going to happen the next, you know, 5 to 10 days. But you give me a price with a monopoly, oligopoly, with a growth algorithm and a certain TAM and a certain set of people, and I go, okay, I know what the skew looks like on a 3 to 5 year basis, or even a 2 to 5 year basis. And is that very attractive or not? I mean, Buffett moves really, really fast on fairly limited information. Why? Because there's only certain variables that really matter. And you just use deductive logic from that. If your variables are constants, or you believe them to be constants at least, and you get a price that affords you significant skew and time is your friend, then you can put capital, you can put a lot of risk on. That's the way we do it. But, you know, part of your questions, and this was something You know, I'm still reforming perfectionist, and for those of you who are, you know, this is one of the biggest lessons if you want to come into public markets, is you can't throttle this. There are some parts of this you have to let it nuance, and it's very hard to get there. And I'm not telling you to be slack. That's not at all what I'm telling you. Is some parts of this are unmodelable, but you can simplify it where you go, if these things hold, which is what I believe them to be true, at this price, the skew is unbelievable. And skew is defined as risk to base in our shop. Some others will use expected value. We don't. We believe the optionality, like this business is a real options business. Because we're in the liquid world, we get to decide if we want to re-underwrite or exit every day. And you are always learning new things. So the way to think about the future is it's dynamic decision trees. It's always a series of probabilities. And as you're learning, you're always updating those probabilities. And your best investments, generally speaking, keep cutting off the lower leg and improving the base and the upward leg. And that's my experience. And what I found, there are other people who are extremely good at finding inefficiency through complexity. I love inefficiency through simplicity, because you don't have to do it that often. Markets are efficient most of the time. That's another fundamental belief of ours, but it's not inefficient all the time. And if you're prepared, you don't need many shots at this to make this incredibly lucrative. It's a really, like, you need to design a game you can win. And make sure it's really productive and lucrative for you to win it. But don't design a game which you can't play for a long period of time. Too hard.
Really, really valuable advice. I think especially because you know, when us and like other students often start out, the view is that, you know, the bigger your model, the more complex the idea, the more thesis points and things flying in, the better. But it's yeah, I think it's really great advice for everyone that simplicity has a sort of beauty to it and a power. I know we're sort of just running short of time. We don't want to keep you from the Florida sun, but Karthik, you had one question, and maybe I'll wrap up with like one other final one. But yeah, well, what Karthik was asking was if you could talk about your sort of short book a bit more. And he says, in other talks, you've cited extracting the time arbitrage of the market and tax efficiency as additional reasons to hold compounders over the long term. What's the sort of rationale for the short book, on the other hand? Does it supplement the long book, and or is it a key source of alpha itself?
Both is the answer, Karthik. Thank you for your questions. Thank you for viewing some of the materials too. So here's what a short book does. And there's multiple uses for a short book. The first and most, in no particular order, one of the core advantages of a long short portfolio is it lets you lever long. It's a balance sheet advantage. And the short book lets you lever long. If you lever long without a short book, you're increasing fragility in the system. You can definitely do it. It's just a question of how far do you want to do it. And the short book lets you reduce the mark-to-market knockouts that you would be vulnerable to in a public market heavily levered long portfolio. So that's point one. Point two is alpha mining and P&L mining. You can make real money on the short side. The math has changed fundamentally. Please go see, I have a video called The Evolution of the Hedge Fund World, or the evolution of long short equity. I can't remember now. There was an NYU class on my YouTube channel that'll outline all the math of the short side for you. But yes, there's a lot of alpha to be mined. So alpha in the long side, if you generated 300 to 500 basis points of long alpha sustainably, you can build a very large business. And short side is a little bit more inefficient than the long side in alpha mining because it's just that much harder. And we've generated a lot of short alpha. It just needs to be ported into a balance sheet that can take advantage of alpha. So for us, the two reasons that we do it, one is to let us lever along the balance sheet. And the second one is to mine alpha. And when you have long short spread, which is the difference between your long alpha and your short alpha, and you compound that with a little bit of a higher gross exposure, that was the whole reason why the long short equity business model was created. But you need to do it in a very careful way, because to generate alpha on a sustainable basis is very, very difficult on the short side. It requires a decided purposefulness to it. It's a very different industrial design than our long side. It's not, none of them are pairs. We do have hedges that let us do that levered long in a very effective way. But the design of the short portfolio is so vastly different because the portfolio is designed on a diversified structure, not a concentrated structure. The error rate is higher and the right tail is more deadly than the long side. It requires far more active management. But those are the primary reasons that we do it. And, you know, I've been a short seller for 20 years and the game has changed profoundly since GFC. I mean, profoundly, mathematically, incredibly different. And we've had to evolve with it, but it still has tremendous value in letting us lever long the portfolio and mine alpha to bring what we believe is through cycle superior returns. But it's done in a very different way than it was pre-GFC. It has to be done with a higher net structure to generate higher through cycle return.
Awesome. Thank you very much, Ian. I hope that answers your question, Karthik. And yeah, now perhaps just as a final and concluding one, perhaps briefly, just to not keep you, Jan, but maybe sort of drawing away from all the sort of really specific questions on, you know, investing and doing research and modeling and entry and exits and sizing and portfolio construction, just on a much higher level, much more general. You know, everyone on the call today are students, aspiring investors, I think mainly. Just perhaps throughout your own career, you know, you talked before about some of the sort of struggles, perhaps, or also some of the sort of things which mistakes which you made in your own career. Perhaps just sort of drawing on those and on the upsides and the positives. Do you have any sort of final bits of advice, tips? Yeah, just any advice really for those on the call who in helping them begin their own investing careers and in cultivating, you know, the right sort of talents, the right sort of attributes to one day be a good investor.
Sure. Look, there's a bunch of stuff in here. And by the way, thank you again for your time. You've all, you know, aggregated into an incredible institution, and first and foremost, I think it's more important that you learn how to learn, and that you know how to develop and foster deep relationships, because those two skills will get you everywhere you need to get to in your life. And you've got the opportunity to do both. I prepared a video that I taught to Columbia May of last year. It's in my YouTube channel called Mastery Learning How to Learn. The first 45 minutes will give you everything you need to know on high performance learning. It's applicable to any industry. It's nothing specific to investing. But I think actually that's the most important thing that you must invest in yourself to do. The second part of that is have deep relationship skills, because the codependency of great relationships will take you to greatness. Nothing great is ever achieved on your own. And you have a very target-rich environment of peers to help you in your life journey to achieve your goals. So let me conclude on struggles and mistakes. You're going to struggle all your life, and you need to know how to embrace it. Why? Because struggle is the neurological precursor to insight. And if you're going to lead, you don't do stuff that's easy. You do stuff that's hard. So pressure is a privilege that's only given to those who've earned it. If you want a life that's absent of struggle, go try the hedonic treadmill and see how long that lasts for you. A life that you actually seek is one that's filled with fun challenge, fulfilling challenge. And without that struggle point, which is just outside of your ability all the time, it's not fun, guys. It's like playing video games or games that are just easy to win. You know, it's good for the ego, but it's really not fun. Well, that's a life paradigm you need to just fully encapsulate. Now, the other part of this is that the struggle is too extreme, that stress will destroy you. So you need to be very smart about how you measure that. Too much of it will literally kill you, right? And that's called, eustress is peak stress. Stress is the negative stress. Too much of it, and your body will eventually break itself down. The next part of this is mistakes. So people have talked about the 10,000 hour rule. Even Erickson himself says that's not true. It's actually based on repetitions, right? It's reps, not hours. And even more important, it's feedback loop on mistakes towards perfection. So our goal is excellence, not perfection. And for those of you who are perfectionists, work on this. You're like, honestly, I cannot tell you how hard life is going to be if you believe that life is perfect and you even have a shot at it. You're always going for excellence. You are not going for perfection, and mistakes will guide you. So one of my life's rules I've shared with my children constantly is fall on your knees, don't fall on your ass, right? What that means is fall forwards. Just keep falling forwards. Why? Because if you're not making mistakes, it means you're not making any decisions of consequence, which means you're not going to ever do anything that's important. And the earlier you learn this in life, the faster you're going to go. And decisions of consequence requires the vulnerability that you will make errors. But mistakes will be your greatest gifts if you can survive them. So early in your career, you need to find bosses that will train you and will have your back. And you will know instantly if they have your back or not. I have had the great honor and luck of several bosses that have changed my life because they had my back to the hilt. There are times when I have made some ungodly mistakes, and usually on their vacations, by the way, where we would have to deal with a call of a stock that has gone 50 or 100 the wrong way. And you know what? Ian McKinnon, who was my boss at Zip Brothers, he would just go, Yenster, what do we got to do? No, what the hell, whatever. Explain it to me. How do we make a good decision? On to the next one. Dust me off, grab me by the scruff of the neck, get me going. The difference between that kind of a boss and one who's going to crush your skull when you're down is the difference of a lifetime. And I have had the great honor and luck and benefit of having a small handful of bosses who treated me and had my back to the hilt. And I wish that for all of you. So your mistakes are your greatest gifts if you learn the lessons from them. So my greatest insights, and that some of which I've shared with you today, I wasn't born with any of them. They came on the other side of some horrendous mistakes. So I've shared with them on some of the the podcasts and the lessons of some of my most embarrassing public mistakes ever in front of my teams that have given me enormous gains. So the clarity around the horses and the oligopolies and monopolies came from the 3 worst years of my professional investing career. 14 years of extraordinary, 3 years of okay, and it gave us blinding insights. And that's the lifetime of benefit that I'll have from 3 years of excruciating pain. And so just, mistakes is what usually it guides you towards where you have to focus your energies if you're introspective enough, if you check your ego, and that you know how to learn from it. We can spend a whole session, which I'm very happy to do another time, on more detailed what those mistakes were. I wish you all well for your finals and your summers, and I hope to see you again soon. Some of you probably are coming into our industry. This is an incredible industry. If you love to learn, if you're curious and you're competitive, there's not much better. But for those of you who are on the fence, if you can't take the hits of the emotional pain of making mistakes in a very public setting, either get the therapy now or don't come. Because save yourself, there's plenty of other ways that you can be productive in life, and you're all more than capable and hardworking, I'm sure. So I'm grateful again for the invitation, Johnny and team, and thank you again, and hopefully we'll see you soon.
No, thank you so much, Jen. Some really, really valuable advice in there for everyone. Learn from your mistakes and pursue excellence, not perfection. The ones I'm going to be taking away. But yeah, really, thank you so much, Jan, for coming and speaking. Not only in these small bits of general career and life advice, but for all of the really, really detailed and specific insights you shared. Really, really valuable for us. And yeah, especially for all of those of us who are doing internships or beginning work later this summer, will no doubt prove immensely valuable for us. So yeah, thank you so much, Jan. Thank you everyone else for coming. And and I won't keep you away from the Florida sun anymore. But
not at all. The last thing I want to say to you guys: have fun with your careers, your lives, guys. Have fun. I mean, look, you guys are all really hardworking people. I'm a double immigrant. I know how to work myself to the grindstone. All right, and I'm sure that resonates with many of you. But it's like you only live one life. design it so that you can work hard and have a hell of a lot of fun. It goes really fast, but you have to design it in so you truly will enjoy it, right? And you have the privilege of choice. You all do. You have the privilege of choice. Choose wisely, but make fun a priority. And trust me, you'll be more successful because of it. Anyhow, guys, thank you again. Be well. Good luck.
Thank you so much, Jan.
Take care.
Okay. Take care, everyone.